I once met one of the top real estate entrepreneurs who was about 95 years old here in Los Angeles area. And he said to me, I haven't paid $1 in real estate capital gains taxes since 1948. And
Wow.
that's phenomenal. And that's why he's worth probably close to $1 billion. But yeah, so I think planning ahead and again, having the goal in mind is so important to have proper tax strategy, both on the year over year basis, but over time on the estate planning, from a estate planning perspective.
Welcome, my fellow Flowmasters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right: the degree, the career, the income, but you still feel like there's just another level waiting. Here we explore how real estate can become that next challenge worth building so that you can take ownership of your future and create a life by design. Today, we're joined by a very special guest, Mr. Dimitry Farberov. Dmitri is a principal and senior wealth advisor at Compound Planning, a high-tech registered investment advisor serving high net worth clients. With over 18 years of experience in wealth management, he advises entrepreneurs, professionals, retirees, and families on investment strategy, tax-efficient planning, estate considerations, and long-term wealth preservation. Prior to Compound, Dmitri held advisory roles at Miracle Mile Advisors, IDB Capital, RSM Wealth Management, and Comerica Wealth Management. So Dmitri, extremely happy and excited to have you here with us. Thank you, and welcome to the show.
Yeah, Chris, thank you for the opportunity. Always great to chat.
Awesome. Sounds like you've been on a journey, gone through a bunch of different kind of ventures and over the years, and just curious, what led you into this world of wealth management, and how has your approach evolved over that 18-year period of advising your high net worth clients?
Right. It's a great question. I joke that it started off when I lost, it's a true story, but it's tongue in cheek, that I lost my bar mitzvah money on a stock tip. I basically, at 13, invested in a company that was told to me by a family friend and thought I'd be a millionaire by 14. Alas, it went to zero. But realistically, it started off really a journey of trying to figure out how the markets work. I picked up someone gifted me a book on Warren Buffett, Charlie Munger, and I really started doing balance sheet analysis as early as probably 13, 14 years old. And it started the journey of how things work, what causes things to go up and things to go down, coming from a family of engineers, hence the name. In Russia, I think everyone is a mechanical engineer of some kind. But yeah, the how things work part was very interesting. And then that lends itself to understanding like why markets move, why people make decisions with hard-earned capital. So a study of behavioral finance has really been a focus of mine for the last probably 2 decades. And so the combination or the intersection of fundamental analysis, which is that Warren Buffett's Charlie Munger school of understanding balance sheets, but also the behavioral aspects of money and the study of technical analysis and really the understanding of trends has been a true passion of mine. So I try to fuse those two. And of course, I just love working with people. Prior to officially joining the world of finance, I wanted to pursue international diplomacy and creating world peace and so on. But it's just the desire to help people. I love the idea of taking complex subjects that are just infused with emotion that make people make poor decisions and narrowing it down to the X's and O's of personal finance and really connecting with people on a personal level, understanding what their fears are, their wants are, their goals, etc., and ultimately helping them make decisions that are actually not that complex, but simplifying them as much as possible so they can be successful in whatever they want to achieve.
That's great. You hit on a lot of points there that brought up memories of my own life. I mean, I'm an engineer by trade, so that's one thing. But it's interesting because as an engineer, I was never interested in finance. But then during COVID, I also started reading books on the stock market and dabbling in the stock market. Lost some money there as well. Not all of my money, but I just did a little bit at a time.
It's part of the process.
Yeah, definitely.
Yeah.
But the emotions like really got into it. Oh, I love this stock. I love this stock. And I just loved the stock, but I would watch the charts and then it would tug on my heartstrings. For me, that kind of strayed me away from stocks, brought me over to real estate, and that's worked out for me pretty well. But yeah, there's probably a lot of engineers listening. I really try to target other people that were like me, and so a lot of high performing professionals in the STEM world and stuff like that. And what I learned by reading this stuff is it's actually very fascinating, very interesting. And for engineers with that technical mind, I'm sure you can relate to this. It's just, there's so much you can learn and get into, and it's like a rabbit hole. You start going down that rabbit hole and just one thing after another, but it's actually fun.
Yeah. Yeah, one thing I'll point out about engineers, I've worked with a number of them throughout my 18 plus year history in an advisory role, is that very smart. They like to teach themselves every part of the process, do it themselves. And oftentimes they lose decades of opportunity because they don't hire the advisors that can help them see their own blind spots. And so they eventually learn, most of them, and they become decent investors over time, much better than the average individual. But that journey just takes so much longer. They can cut that. If they don't want to pay a fee for that service, because why would they? I can do it myself, right? But that journey can take quite a bit of time, money, sweat, and tears, and it's generally not worth it if you can skip that part by just having just a fiduciary advisor in your corner.
Absolutely, yeah. And I can relate to that as well. I also started trying to do it all on my own, right? And I think I spent a solid 3 years just trying to learn on my own. I was working with an agent, and that agent wasn't really focused on investors anyways, and so I think I knew more than he did about investments. So really I was just working on my own, just using him to show me the properties, and that did not work at all. Yeah. And for me, it wasn't necessarily a wealth advisor, but nonetheless, like finding people to coach me, to guide me, to mentor me through the process. And eventually, like you say, we all get there. If we want to be successful, we do end up getting to that point where it's like we need someone who's an expert like yourself in the field to guide us through and skip all the wrong decisions. Just take me to the right decision.
Right. And sometimes we have to go through that process to become great investors or great at whatever we do. But having that coach, like you said, that mentor guide you, it's a shortcut that generally shortcuts aren't necessarily the way to go in life. But I do think having a coach is definitely going to guide you to the destination much more quickly.
Definitely. So in terms of real estate, how should real estate investors think about balancing cash flowing assets with more traditional investment portfolios?
Yeah, I think the most important part about just investing in general is about having transparency around the balance sheet and an income statement. So one doesn't just become a real estate investor or a stock investor or whatever it is, antique investor. It's about understanding your cash flows. If you have positive cash flows over a period of time that you can project into the future, now you can, and you have no debts, right? Now you can project into the future, how to optimize those cash flows, right? Some might choose real estate, some might choose stocks, and I would advise to do some combination of a diversified approach to investing in assets. But most people that I come across on a more retail level, they don't have the transparency. So they want to invest in real estate, but they've got credit card debt that they're paying 20% in 20+% in interest on. Mm-hmm. And they say, should I be investing in real estate or should I be paying off my debt or contributing to my 401k? All those factors are important. But you can't get to those factors until you know what your financial landscape looks. And once you have that in place and you have the transparency, at that point, you have to really know yourself, right? Harkening back to the behavioral finance. I think there's a certain investor personality. We all have a personality, right? That causes us excitement. And for some folks, real estate is boring. For some people, it just drives them. And some people don't want to touch stocks, and other people, that's their most. So I would just say, once you understand what your cash flow situation is, now you want to think back or think ahead 5 years, 10 years, right? Where do you want to be? And start making projections over a certain return stream. So for example, if you're saving, I don't know what the number is, let's say $10,000 a month, right? That might be high for some folks, that might be low for others. If you're saving $10,000 a month, what is the return that you want to see to achieve the goals that you want to achieve? Is it 10%? Is it 5%? Is it 20%? And that's going to create kind of the return profile and the ultimate investment vehicle that you're going to need, understanding the risks and trade-offs in each of these, whether it's liquidity or just volatility, et cetera, leverage that you have to assume. That's how I would approach it. It is transparency first, goal in mind, right? And that goal is not a 1-year goal, although that's important, but having a 5, 10, 20, depending on one's age, goal, and then working backwards. What's possible? What willingness you have to assume certain types of risk, and kind of fusing that within the profile, your investor and personality, I think is the key to success.
Gotcha. You mentioned diversification, and so I do want to ask, because that's a hot button topic. I feel that a lot of people feel very strongly one way or the other on. I have my opinions on it, but curious to hear your thoughts on that. Really just in terms of, should we be diversifying? If we're like gung-ho, like I'm gung-ho about real estate, so I'm all in on real estate, and I have some money in stocks in my retirement accounts, but even that I'm like debating just taking that out and throwing it into real estate, because this is what I've made my businesses revolve around. So yeah, curious to hear your thoughts on that.
Yeah, I think diversification is all about the stage in life that you're in. So my clients, just to give us a slight background, I manage currently about $225 million in client assets. And my average client is about $7 million in size in liquid assets. And they've already made their money, right? Or in the process of making significant amounts of money. And it's more about legacy for a lot of these folks, tax planning, estate planning, creating more efficiency in how they can maximize the growth of their dollar. But when you talk about someone who's just in the accumulation phase of their lives, right? Diversification is not necessarily it's not going to create kind of near-term success, right? It's going to be almost a hindrance to that goal. It's going to prevent you from losing the most amount of money in the worst possible market environment, but it's not going to get you the 20, 30%, 50%, 100% returns that one might make if they were concentrated in one stock or one sector or one asset class. So I think diversification is a tool not to lose money, but it's not necessarily the best tool to make money in a short period of time. Over a period of 30 years, 50 years, right? I think that is probably the best methodology to achieve multi-generational net worth. But ultimately, when we think about our careers, for example, we're not diversified. We don't say get 10 jobs. We get one job and hope that job or that business, right, is darn good and that there's longevity there. And you can use the cash flows from that to leverage and compound over time. So to the point about diversification, I think the average that it's diversification, as I mentioned, is about not losing money. But how you make money in any investment vehicle is what you pay for it, right? It's not about buying great real estate or a great company. It's about buying great real estate at a reason, or perhaps even poor quality real estate, but at a very attractive price point that you can improve, embellish, etc., and then sell it to someone else that wants a lower risk profile. So it's understanding that point as well. But if you don't have that in mindset, and you don't want the risk of a single asset portfolio or a single stock portfolio, then diversification is the way to go. But it's not for everybody, and it's certainly not for everybody because they're not at the same stage in their lives.
Gotcha. That makes sense. I know I've heard Warren Buffett talk about most Americans should just put their money in the S&P 500 and just let invest in America is his thing. And
sure.
But then at the same time, he certainly doesn't do that because he's the expert. He's taking all of his time. That's his business. He's going out and finding all the best businesses to invest in long term. And it's of course a long term strategy with him. I think it was Charlie Munger. Maybe Warren Buffett said this. I think it was Charlie Munger who said something. He said a lot of extreme things. I feel like I didn't follow him very closely, but heard some quotes from him about basically diversification being for like, I don't remember the exact quote, but basically being like a terrible idea kind of thing. Oh, if you're just going to diversify, then you don't know what you're doing kind of thing, which I guess S&P 500 is totally diversification, right? You're diversifying across that market. But the thing is, most people aren't going to spend as much time as I'm doing on real estate, as much time as Warren Buffett does on picking stocks. It's just interesting to hear those different perspectives in this cases. Yeah.
To that point, just to provide a little bit more context, the S&P 500, we just actually crossed the 100-year mark since this data was taken. So if you look back on the S&P 500 over the last 100 years, it's returned about 10% a year on average. Some years more, some years less. Actually, very few times has it actually done 10%. And when you're investing in the 500 best companies in the world, which are most often globally diversified, that is a great long-term approach. But is 10% sufficient for you, right? And so if you think that 10% is a poor return profile, then you shouldn't be diversified,
Yeah.
right? If you think 10% is fantastic, then you also have to ask yourself, what price am I buying the S&P 500 at? I'm having conversations with clients right now and saying, if you look at the valuations of the S&P 500 today, right, you're probably your next decade of performance expectations should be in that low 3 to 5% range because valuations are very high, even if you're buying the best companies in the world.
Yeah.
So but 10% might be great for most people. And one of the benefits is to real estate is that our ability to take leverage, right? And put 25% down, and now you can take a 7% return and magnify it.
Mm-hmm.
Well, you can theoretically do that with a diversified portfolio as well by going on margin. Don't necessarily recommend it for most people, but you can do more of an apples to apples strategy.
Yeah.
One additional point about Warren Buffett. If you look at the last 25 years as Berkshire Hathaway has become more and more diversified, so to speak, because it's just so large,
Mm-hmm.
its performance has not been better than the S&P 500. So to his point, right, if you don't know what you're doing and you're not passionate about, Warren Buffett loves buying companies,
Mm-hmm.
and this is what drives him, right? But if that's not what drives you, like in your case, real estate drives you, then you'd be better off buying the S&P 500 and dollar cost averaging
Yeah.
into that strategy over time. And you'll probably outperform just about any strategy out there just because you're building the right financial muscle.
Gotcha. Yeah. And I don't mean to go so far into stocks. It's just interesting to me. But
Sure.
yeah,
Sure.
I've been slowly selling off more and more of my stocks because it's just gone so high, and I don't know. I'm not trying to time the market necessarily.
Sure.
I see the chart going like this, and it's tapering off. And it's like very smoothly
Yeah.
going like that. And at some point, it's not going to be perfectly smooth doing this. At some point, it's just going to fall
Right.
or it's going to go back up. And so I'm leaving a little bit in there because it keeps going
Right.
up. So let me take advantage of it.
Or
But,
just that point, some folks think it has to go up or down, but it can just be stagnant for a decade.
Yeah.
It doesn't have to do anything and just consolidate in time.
Yeah.
And that's actually how most consolidations take, and they frustrate investors of all kinds.
yeah. Awesome. Okay. So I know part of what you do is in the tax world as well. What are some of the biggest tax planning mistakes that you see entrepreneurs, investors, high net worth individuals make?
Yeah, it's all about planning and not thinking ahead of time where you want to be 5, 10, 20 years from now and then working backwards. Most people just dive in. They want to do real estate and they just buy their first property, right? But they're not really thinking about, okay, is the structure that I'm buying that property in today the best structure 30 years from now when my net worth is $25 million and I'm north of the lifetime gift exemption, and potentially my heirs will have to pay 40% estate tax. But if you don't need, for example, the cash flow from a property that you're buying and you can park it outside of your estate early when the valuation is low, then the entirety of the growth, for example, is outside of the estate. And so there are a lot of tools, particularly in the real estate world, right? The tax code was written ultimately for real estate investors more so than any other investor class, and actually frustrates me a little bit that the stock world doesn't receive the same benefits. But that's one of the appeals of real estate investing, is there are just so many tax benefits if you structure it properly. But you have to know what these are in advance to be able to make the right decisions early, so that 30 years down the line, when you've got a real estate empire, now most of the cash flow can be tax-free. You can do exchanges, et cetera, that you're not going to pay in taxes. I once met one of the top real estate entrepreneurs who was about 95 years old here in Los Angeles area. And he said to me, I haven't paid $1 in real estate capital gains taxes since 1948. And
Wow.
that's phenomenal. And that's why he's worth probably close to $1 billion. But yeah, so I think planning ahead and again, having the goal in mind is so important to have proper tax strategy, both on the year over year basis, but over time on the estate planning, from an estate planning perspective.
So do you have a lot of clients who do 1031 exchanges? And if so, I've heard mixed things about that too. And Grant Cardone just won't do them at all. I won't even deal with it, because to him, he said that if the buyer knows you're doing it, it gives the buyer all the leverage, because they know you got to get out in this time frame and all that.
It all depends on perspective and context, right? If your goal for a particular investment is 30% like ROI on that investment, you're probably not going to do that in a 1031 exchange, right? Most often, the clients that come to me for advice on a 1031 exchange they're yielding probably like 5% on the real estate property, but obviously it's highly appreciated and maybe it's a headache now. So maybe perhaps swapping that into a 1031 type of DST, 721 type of fund allows you now to remove the headache and maybe get a 6% yield without paying the capital gain. It makes sense there. But if we're talking about someone who, is making a 7% or a 30% return on the property, but it's overvalued, for example, and they want to get rid of it, and the DST is going to get them a 7% return on property over a 5-year period, they'd be better off just paying the capital gains and just doing it that way.
Gotcha. Okay. Yeah, it's so many people simplify it, and then you get into the weeds, and it's okay. It's not as black and white as it sounds. Interesting. And we could talk all day about the taxes, and I'm no expert in this by any means. But another thing too would be whether or not you're a real estate professional status on your and all that. Yeah. Interesting stuff. Okay.
That's a big factor. Right?
Yeah.
It's a huge factor. The real estate professional status is such a great tool, especially if you've got a stay-at-home spouse, right? One spouse is earning, say, W-2 income or has a company that they're running, et cetera. They can't be a real estate professional.
Right.
But a spouse can be, and especially a stay-at-home spouse. And there's so many tax benefits against ordinary income, particularly in high tax states like California.
Gotcha. Hey, I'm looking for a spouse, particularly in the real estate realm. No, I'm just kidding. I think I'll qualify.
But she has to be a real estate professional.
Yeah, I think I'll qualify now that I quit the day job and I'm focused 100% on real estate. But yeah, that's a running joke. I took a tax and legal class, and that's the tax attorney who taught the class. That was his running joke. Hey, if you're single out there, go find a good realtor to marry.
Yeah.
Awesome. Okay, so I know another avenue. You do a lot of stuff, which is great. You're a wealth of knowledge. Yeah, really happy to have you on the show. In terms of estate and legacy planning, when should investors start thinking seriously about estate planning and wealth transfer?
Yeah, I think estate planning starts from day one. So first, it starts more of risk management. So have a basic estate plan in place. It costs $500 to a couple of $1,000s. That's basic living trust, healthcare directives, pour over will. It's essentially, if the worst case scenario happens to you, your assets don't go to probate. And in states like California, where probate is a very long process and expensive process, you don't want your family or siblings, et cetera, next of kin fighting over those assets. So having a basic estate plan is a no-brainer for everybody who has any assets. But beyond that, then you have to start projecting where you are today, and let's say even having a conservative growth profile of 6% on your assets if they're diversified. Where does that project to over 30 and 50 years, right? Depending on one's age and life expectancy. And if that at any point in time projects to be north of the lifetime gift exemptions, as of 2026, that's $15 million per individual. So a married couple is $30 million. That's a big hurdle to cross. I do think over a lifetime, that number is going to drop considerably due to some of the political trends that will likely happen. So let's say that number is 10 million, right? And so now any dollar above 10 million at the time of both spouses passing is going to be taxed at 40%. This is particularly important to real estate investors because there's illiquidity in their investment vehicle. So imagine you're worth $50 million, and a lot of folks in California that I come across, they bought a property in 1980 with a couple of family members, and now fast forward to today, that $1 million investment is worth $100 million, and it's just one building, right? And they're not astute individuals from a financial planning perspective, and then they pass away. And oftentimes these folks are immigrants that don't necessarily think about tax planning or estate planning, et cetera. Their kids want to, and their grandkids. But now all of a sudden $100 million passes to the next generation, assuming they even have a basic living trust and avoids probate. All of a sudden 40% of that $100 million, so $40 million, has to be paid to the IRS within 13 months. So essentially, now what do you do? So some folks buy insurance for liquidity purposes well in advance, but if you haven't planned for that environment, you have to sell the property or leverage it even more if someone's going to offer you that dollar amount to pay the IRS. And a lot of folks like George Steinbrenner of the Yankees was well known because he bought a $100 million insurance policy, because you're not going to sell the Yankees. A lot of farm owners have to deal with this issue as well. If you follow the show Yellowstone with Kevin Costner, that was an issue there as well. With they have no money, no cash flow, but they have a plot of land that's worth $500 million. And so the point of it is, It's really about knowing where you're likely to be, and you can create scenario analysis of, okay, if I'm at $10 million by the time I'm 100, that I need to do X, Y, and Z. If I'm at 50, it's another story. So it's by knowing the end in mind. Now you can start planning about, okay, the current investments that you have today. What are they for? Are they for your lifestyle? Are they for cash flow? In which case they have to remain within your estate. But if they're for growth, right? If they're in the growth bucket, like multi-generational, then you can move them outside of your estate using that lifetime exemption that's currently extremely high, that $15 million number that I was talking about per individual. Move it outside of your estate, and now the entirety of that growth is going to be outside of the estate for the beneficiaries. So that's a great planning tool, is just thinking ahead and then going back and creating the right location of your investments to avoid estate tax.
Where would you move it outside of the estate then? Into some other type of trust, like
Right.
a land trust or something?
Yeah, exactly. Right. So there's so many tax loopholes in the tax code, right? So if you're married, you can create a trust for the other spouse called a spousal lifetime access trust, where you can park assets and essentially freeze the estate. Whatever growth of those underlying assets are for the respective spouse is outside of estate tax. You can create irrevocable trusts that you gift money for generation skipping taxes. So there are just so many different vehicles. There's philanthropic planning. Is charitable trusts are a huge part of what I do. For example, if you're in your mid 50s or in your 60s and you have a illiquid asset or a liquid asset that's low basis, right? So selling it would basically hit you with a massive tax bill. You can gift that asset to a trust, right? This charitable trust, and now you can create an annuity stream and sell that asset within that trust, pay zero taxes on it. And then you also, so you can diversify it at that point in time, either in other real estate or in stocks and bonds, et cetera. And you get a tax deduction as well on the gift. So you get the tax deduction, you get the ability to diversify without paying tax. And now you can create an annuity stream for 10, 20, 30 years, right? For the duration of your life. That's also tax efficient. So that's a charitable remainder trust as an example. So there are a lot of vehicles that one can use. So if you plan ahead, there are enough methods to literally avoid paying taxes at a high level. But if you don't plan ahead, you'll get hit with them.
Wow, that's incredible. I had no idea about all these different loopholes and even considerations. So this is great. I'm on it.
And you're more of an expert than the average individual, right?
Yeah.
So can you imagine if you haven't delved into those items, then...
Because I even had an instructor in one of the courses I took say that, look, if you just, and maybe this, I don't know if this has changed or if it's just he didn't know either, but a few years ago they recorded this course and he was saying that at the time of recording, whatever real estate you accumulate, when you die, it goes to your heirs and then they get a step up in basis and then they don't have to pay. So is that only up to that gift amount, basically, that is true?
Right. You get a step up in basis on everything, right? But if it exceeds the estate lifetime exemption, right, then every dollar above that you owe 40% to the government on.
Okay.
For most folks, they're probably never going to even cross into that threshold.
Gotcha.
But if you start early enough and you invest wisely and you avoid those mistakes, then 15, 20, $30 million is not such a huge number.
Got it. Okay. And then for someone building a real estate portfolio right now, what's one wealth building principle that they should not ignore?
Get a coach, get a mentor, and make sure that you're bouncing these ideas off of that individual. Because as alluded to, the biggest factor that prevents people from achieving long-term goals are financial mistakes. And because we're emotional around money, we all make them. Yeah. It's inevitable. But if you can limit those, that will help you achieve long-term success.
Absolutely. Yeah, we don't know what we don't know. Right. Yeah. Like I'm learning right now, but also just when I tried doing it on my own for 3 years, I got nowhere. And then I went and took like 25 classes in real estate investing. And I'm like, holy crap, I had no idea of all these different strategies you can use, creative ways to buy deals, to partner with other people, and all these different things. So it just opens up that whole world.
Yeah.
Okay. It's been great having you, Dmitry. Before we wrap up, where can people find you? Where can people connect with you if they're looking for a wealth advisor and want to bounce some ideas off you?
Yeah, thanks for asking, Chris. So I'm quite active on LinkedIn and on X, formerly known as Twitter. So you can just pull my name up and you'll, whether Google or elsewhere, you can find my profiles there. I post probably a couple times a day on various different topics in either finance, capital markets, or estate planning, wealth planning, and tax planning. Just a lot of information. You can go to the Compound website and pull up my profile there, and there's a link directly to schedule something with me. And I'll just end with this thought. I work, as I pointed out, with ultra high net worth clients who've already achieved significant amounts of net worth. And many of you are just not quite there yet on that journey. And some of you will get there. But don't let that stop you from reaching out to someone like me. There are a lot of great advisors. There are a lot of poor advisors. Make sure whomever you talk to is a fiduciary. And bottom line is, if you have any questions about anything, don't let your lack of net worth today stop you from having a conversation. And I'm more than happy to have a conversation with anyone, whether you have $1 net worth or $25 million, because I understand that the framework, the foundation you create today is going to change your life, your life of your family, your community, and eventually make an impact in the world, make it a better place. So I love doing that pro bono. So don't let that net worth number scare you off from having conversations with someone like me.
Amazing. I appreciate that, Dmitry. I appreciate your time. It's been great having you today. Great conversations. And yeah, I feel like people like what you just said, like people who have that approach really just go further in life. And I just the more people that I meet that have had all the success that you've had, that seems to be the case. And it's the complete opposite of me, let me do it on my own. It's how do I help more people? And I'm slowly learning all this stuff, right? But it's just how do I help more people, impact more people, whether or not it immediately
the more you give,
adds. Exactly.
The more you give, the more you get.
Exactly.
Yeah.
Awesome. All right.
Yeah.
Appreciate
Chris,
it.
it's been a pleasure. Really appreciate it.
You as well. Thank you. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.